is pumping nearly $800 billion into the economy. The Federal Reserve adding trillions more, and Wall Street is in the midst of, at least we hope it's the midst, of its strongest rally of 2009. What does it all mean for investors? Joining us now to try to sort through all of this is Paul Schatz from Heritage Capital in Woodbridge. Welcome back. Nice to see you again.
Good morning, Chris.
Let's first talk about the Wall Street rally, because we've seen some good signs. We've seen some gains, and we haven't seen that for a while. Should we be feeling good about this?
Clearly you should. We're up roughly 20% from the lows. But we've been there before. Don't forget, in November, we were here, and we rallied 20%, and even back in October, we rallied almost 20%. It's not the first time, but this one has more legs than the previous ones did. I expect this to rally on balance well into the summer.
And it has legs because it is more balanced across the board?
It's definitely more balanced. You're seeing buying coming in all areas of the markets, not just one segregated area. You're seeing it literally across the board in financials, in energy, and technology.
Yeah.
That's a good, healthy sign for an intermediate-term rally.
All right, you're not a big fan of stimulus plans
I'm
yourself.
not, no.
Why do you feel like they're not going to work?
History clearly shows that most stimulus plans are loaded up with pork. Pork doesn't create jobs. The stimulus plan, number one, should create jobs, jobs, jobs. The one just passed by Congress doesn't do that, and that's what bothers me. I think when all's said and done and it runs out in the third quarter, the fourth quarter, we roll right back down again, and we'll have the third stimulus plan in 4 years. That's a problem.
Yeah, where we are right now, I'm sure you're getting a lot of questions, and you have continued to get questions from investors. You've got some tips. Let's take those tips one by one. And one of the things you say is to use, if you weren't happy with where you were before, this is a good time to kind of reposition yourself.
No matter what happens, when things go up, people don't complain.
Yeah.
When things go down precipitously, as we've seen in September, October, November, and then the first quarter this year, people say, I shouldn't have been here in the first place. Well, you've got a 20% plus rally. If you don't like where you've been, now's the time to change.
And you can't just sit back and kind of hope things are going to get better. You have to be proactive, huh?
Absolutely. I think another problem is people, when things go down, they freeze like a deer in the headlights. They say, well, let's just sit tight. They were told to stay the course. It'll get better. That's the wrong. Hope is not an investment strategy. You can't hope your way to retirement. You need to be proactive. If things aren't going your direction, things aren't going according to plan, change them now.
It's also a good time to reevaluate where you are, because some things that traditionally were strong, stocks, bonds, not so much in the past year.
I think that's one of the biggest bad messages that's been sent from the Wall Street community is take your mix of stocks and bonds and let it alone. It'll take care of you. Absolutely not. Does not work. Stocks went down in the fourth quarter. Bonds went down almost as hard as in the fourth quarter. People should look at other assets like currencies, like commodities, maybe not on their own, seek some help, but there are other things besides just plain vanilla stocks and bonds to make you money.
The other tip, the fourth tip, and this is a tough one because people always want to be protected. They always want to there are no guarantees, but they always want to have as much protection. How can you do that? How can you seek protection in this kind of market?
I think the biggest problem now is we've had historic and unprecedented moves by the Fed, by the government. There's going to be unintended consequences down the road. I don't mean tomorrow. I mean in 2010, 11, 12, and then probably for the next investing generation. So again, you can't just sit back and say, geez, what worked in the 80s, 90s should work fine for me today. It's not going to do that. We've got deflation right now. Prices are going down across the board. Longer term, these unintended consequences will result in inflation. I see energy rallying significantly the rest of the summer. People aren't positioned for that. They got to worry about that. They got to worry about what the government didn't worry about for them.
Well, one of the things you hear it in the disclaimers in some of those ads is past performance is not a guarantee of future success, and you do have to keep that in mind.
Absolutely. If you look at Money Magazine or Barron's at the end of the previous year, a lot of folks say, geez, this did well at the end of last year. Let's invest in it for this year. What did well last year often does not repeat the next year or the year after. You've got to find new things. People are going to go back and say, geez, well, last year I may have been able to buy the Japanese yen. It's not going to be the case this year. You need to look technology, energy, and the emerging markets from years and years ago.
Paul Schatz, Heritage Capital, thanks so much for being here.
Thank you.
There is some signs of optimism. We like that. 727. Hey, if you want more information, you can always find it on our website.